Hi, good morning. Today's topic is Advanced Goods and Service Tax (GST). India is a federal country where both the central and the state government have the power to levy and collect taxes through appropriate legislation. GST was introduced in India on 1st July 2017. GST is a business reform and beyond just modification of the rate of tax, GST is changing the process of compliance, thereby resulting in a shift in the way business operates. With the concept of invoice matching compliance, instead of filing summarized returns, you will need to submit the details of all your sales invoices periodically. Based on their criteria of filing returns and extras, either monthly or quarterly, this urges every business to digitize its bookkeeping. Why GST? The indirect tax system had inefficiencies and limitations due to multiple taxes like central government levies like excise duty, service tax, other cesses, state government levies like VAT, entry taxes, octroi, luxury tax, entertainment tax and purchase tax. Multiple tax rates. Multiple point of taxation during manufacture, trade, rendering services and so on. GST allows a seamless flow of tax credit and eliminates the cascading effect of all the indirect taxes in the supply chain, from manufacturers to retailers and across state borders. Here are some reasons to explain why. Number one is simple tax structure. GST replaces several indirect taxes. Further, uniformity in tax rates and the structure of taxation makes GST simple to understand and easy to administer. Eliminates the cascading effect of taxes. The input credit set of process is seamless and the benefit is duly passed on to the consumer. Technology-driven system. A robust and comprehensive IT system would be the foundation of the GST regime in India. Therefore, all taxpayer services such as registration, returns, payments, self-assessment and so on would be available to the taxpayers online, making compliance easy and transparent. Increased revenue. A simpler tax structure can bring about greater compliance, thus increasing the number of taxpayers and in turn tax revenues for the government. The elimination of the cascading effect will directly result in a price reduction of products which will benefit the end consumer. Next is GST tax structure. On every supply of goods and services, a tax component of central and state will be applicable. GST tax structure is explained in chart 1.1. Here, number 1, CGST, Central Goods and Service Tax, and the tax is collected by the central government as it is applicable on the supplies made within the state. SGST stands for State Tax and tax is collected by the state government as it is applicable on the supplies made within the state. UTGST stands for the Union Territory Tax and the tax is collected by Union Territory as it is applicable on the supplies made within the Union Territory. IGST stands for Integrated Tax and the tax is collected and shared between the center and state as it is applicable on interstate and import transactions. Next is how to determine tax. The structure of indirect taxes was origin based and with GST we moved to a destination based tax system. In chart 1.2, we can observe that Ravi Trading Limited located in Karnataka supply goods to Shiva Trading Limited in Tamil Nadu. So it is an interstate supply and integrated tax is applicable. The tax revenue will reach Tamil Nadu since the destination state is Tamil Nadu. GST registration. Under the GST tax system, all the businesses will unify under the one tax GST. This leads to a unified tax registration of all businesses. It eradicates the old taxation structure in which a separate registration was given based on the nature of business. Being registered under the GST law means a business is acknowledged by the Government of India as a supplier of goods and services. Only registered businesses are allowed to claim input tax credit. Next is GST and structure. On registration, each business will be allocated a unique 15-digit PAN-based registration number. This is called the GST identification number. Tips: to get the GST state code list of India, log in to www.delhisolution.com/gst/GST state code list. Type as in the browser. Mandatory registration. The following category of persons have to mandatorily register irrespective of their turnover. Number 1. A taxable person carrying on interstate supply. Persons responsible to deduct TDS, that is government departments. Agents supplying on behalf of taxable person. Casual and non-residential taxable person. Sellers of goods on e-commerce platforms, and threshold exemption is applicable for the seller of services on the e-commerce platform. Input service distributors, a person supplying online information and database access or retrieval services from outside India to an unregistered person in India. Business liable to pay tax under reverse charge. And last one is e-commerce operators. Next is how to manage HSN code and SAC code. HSN code stands for Harmonized System of Nomenclature. The purpose of the HSN code is to classify goods from all over the world systematically and logically. In GST law, the HSN code which is used by the taxpayer will be classified based on the turnover. A taxpayer with a turnover between 1.5 crore to 5 crore in the financial year need to specify the HSN code of 2 digits. A taxpayer with a turnover more than 5 crore in financial year mandatorily needs to specify the HSN code of 4 digits. The HSN code of 8 digit is to be mentioned in case of export and import of goods. SAC code stands for Service Accounting Code. The purpose is likely goods and services are classified uniformly for recognition, measurement and taxation. Services are also classified as per the Service Accounting Code as it is containing 6 digits. Below is explained in detail. The first 2 digits 99 are common for all the services. The next 2 digits represents the major nature of services. The last 2 digits represents the detailed nature of services. Next one is GST rate structure. The GST Council is the body that decides the rate slabs, and the GST Council has been periodically revising the list of goods and services for each rate slab. The government intends to have a lower tax rate for goods and services which are essential needs and higher tax rates for goods and services that are considered as luxury supplies. Below is a list of GST rate structures for goods and services classified across the different GST tax slabs. Number 1 is zero rated. Zero rated tax slab is for GST exempted and zero rated goods and services. This includes essential items including food. Next is merit rate. It is for essential goods and services at 5%. This includes commonly used items. Standard rate. Standard goods and services at 12% and 18%. This includes fast moving consumer goods. Demerit rate. For special and luxury goods services at 28%. This includes luxury cars, tobacco and aerated drinks. Additional cess. Additional cess is 1% to 25% on luxury goods and services. An article outside the GST tax rate slab. Golds, gems, jewelry at 3% and rough precious and semi-precious stones at 0.25%. Now, below is a list of slab-wise GST rate structure for goods and services. For footwear, the retail sale price less than 1,000, 5% GST shall be applicable, and retail sale price more than 1,000, 18% GST rate shall be applicable. Next is hotel accommodation. Tariff value less than 1000 per day, that is 0%. Tariff value between 1000 to 7500 per day, 12%. Tariff value more than 7500 per day, that is 18%. Articles of apparel and clothing accessories. Retail sale price less than 1000, 5%. Retail sale price more than 1000, 12%. Next is supply of goods and services. GST is a supply-based tax, and supply is very important. Until the supply comes into consideration, tax will not be applicable. The taxable event under GST is the supply of goods or services. In the GST taxation system, the term supply includes all forms of supply of goods or services like sale, transfer, barter and exchange, license, rental, lease and disposal supplied or to be supplied for a consideration in the course of or for the furtherance of business. Next is place of supply. In the GST taxation system, place of supply will play a vital role in determining which tax to be charged, like intrastate supplies are subjected to central tax and state tax or union territory. Interstate supplies are subject to integrated tax. Also, the place of supply helps in determining the taxable jurisdiction where tax should reach. There are two key aspects to be considered while levying taxes based on the place of supply: location of the supplier and place of the supply. Next is time of supply. Point of taxation refers to the point in time when tax is required to be paid. This is a mechanism that is used to determine the point in time when the tax liability will arise. Under the old tax regime, the point of taxation is different for each of the tax types. Value of supply. Under GST, the value of taxable supply of goods and services will be the transaction value. The taxable value of all the goods and services consumed in an economy is arrived at based on various metrics. Transaction value refers to the price paid or payable for the supply of goods and services. Next is invoicing. In GST, it is very necessary to aware of the rules of invoicing, as invoicing is an important aspect of tax compliance for every business. In the GST, there are two types of invoices will be issued: tax invoice and bill of supply. Number one is tax invoice. When a registered taxable person supplies taxable goods or services, a tax invoice is issued. The tax invoice must be issued before or at the time of removal of the goods, where the supply involves the movement of goods. In the case of services, the tax invoice must be issued within 30 days from the date of supply of the services. When a registered taxable person supplies taxable goods or services, a tax invoice is issued. Based on the rules of the details required in a tax invoice, a simple tax invoice is shown in figure. Next is bill of supply. When the supplier is not allowed to levy any tax and hence a tax invoice cannot be issued, therefore a particular document called as bill of supply is issued, and a bill of supply need not to be issued when the value of the goods or services supplied is less than 100 unless the receiver insists for the bill. However, a consolidated bill of supply should be prepared at the end of the business day for all such supplies for which the bill of supply was not issued. Bill of supply to be issued by a registered supplier in the following cases: supply of exempted goods or services. The supplier is paying tax under the composition scheme. Next is debit note, credit note and supplementary invoice. To revise the taxable value of GST change in any invoice, a debit note or supplementary invoice or credit note must be issued by the supplier. Debit note and supplementary invoice. These are to be issued by a supplier to record an increase in taxable value and the GST charge in the original invoice. Credit note. These are to be issued by a supplier to record a decrease in taxable value and the GST charge in the original invoice. Mandatory components. The following details are mandatory in debit note or supplementary invoices and credit notes. The nature of the document must be indicated prominently, such as revised invoice or supplementary invoice. Name, address and GSTN of the supplier. A consecutive serial number containing only the alphabets or numerals unique for a financial year. A consecutive serial number containing only alphabets or numerals unique for a financial year. If the recipient is registered, name, address and GSTN unique ID number of the recipient. If the recipient is unregistered, name, address of the recipient and address of delivery with the state name and the code. Next is serial number and date of the original tax invoice or bill of supply. The taxable value of the goods and services or services, rate of tax and the amount of tax credited or debited to the recipient. A signature or digital signature of the supplier or his authorized representative. Recipient voucher. When a registered dealer receives an advance payment for a supplier, the dealer should issue a recipient voucher for the advance paid by the recipient. After the dealer issues a receipt voucher, if the supply does not take place, the dealer can issue a refund voucher to the recipient against the advance receipt. The taxpayer has to perform the following actions on receiving advance receipt. The supplier the supplier needs to issue a receipt voucher for receiving advance receipt to the buyer, person who makes advance payment. The supplier needs to calculate the advance tax receipt, updating advance receipt information in GSTR1. So I hope you understood all the theoretical parts of the GST very carefully. I'll get back to you in next video. Stay tuned. Thank you so much.